2010 to 2012, the Carolinas were home to some of the nation's hottest apartment markets, large and small markets. Apartment demand was strong, rent growth was big due to some strong economies, the lack of a housing bubble in most of these spots, and some great demographics. But the storyline is beginning to change. We're going to talk about that today. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. I'm here with Greg Willett. And Greg, before we dive into the Q1 2013 numbers, let's recap what happened in the Carolinas between 2010 and 2012, because it really was pretty remarkable.
Yeah, these are impressive numbers, and we've got lots and lots of numbers for you today. So let's just immediately jump into one of our graphics here. What we see here are some rent change numbers, occupancy change numbers across the 6 big metros in the Carolinas. And again, really impressive. From 2010 to 2012, for these markets, hiked up rents more than 11%. You have the Greenville, upstate South Carolina area right there on top with 14.4% rent growth, followed by Charleston, the Raleigh-Durham area, and Charlotte. For comparison, the national number was right around 10%, so you saw these numbers in these particular metros really even topping that impressive national figure. A couple on the flip side that were laggards there. Columbia with rent growth of 6% during that time period, and the Greensboro, Winston-Salem area at 4.8%.
And the reason those two markets really didn't get it going on rent growth is that they weren't getting the job growth. And you can see that in this table here. This is showing relative job growth from 2010 to 2012 in the 6 Carolinas markets. And you see Columbia and Greensboro, Winston-Salem on the bottom again. But look at the big numbers elsewhere. 6.8% net job growth in Charleston, 5.3% job growth in Charlotte, and just under 4% in the Greenville, Spartanburg, Anderson area, and in Raleigh-Durham, all way above the U.S. average, which was 2.2% growth over that stretch.
So 2 to 3 years, great performances. We've got everybody hyped up. Now we have to let some of the air out of that balloon and talk about how things have slowed down meaningfully as we get on into 2013. Pattern we really see across the country, but it is particularly pronounced here given that these were starting from such a really strong position. So what we've got here, the occupancy and rent growth numbers as of 1Q 2013. Let's really concentrate over on the rent growth side of things. And you can see that we have 3 areas that are still getting rent growth in that 2 to 2.5% range. The Greenville area, Charlotte, as well as Raleigh-Durham, all at, again, 2 to 2.5%, and that's relative to the U.S. average as of first quarter was 2.6%. And then we have 3 that have fallen into that laggard category, 1.7% rent growth in both Charleston and Columbia, and then actually slight cuts on the rent side, minus 0.3% in the Greensboro, Winston-Salem area.
So just for some comparison, most of these markets had been producing year-over-year hikes of 5% or more for some periods in the past 3 years. So this has been a pretty good slowdown. And so why is that happening? Well, it's not because of the local economies. They're continuing to show good growth. And in many of these spots, job growth levels or I should say total job levels are now above what we had prior to the recession. So they've recovered the recessionary cuts, and they're at new highs in many of these spots. But what's happening in the Carolinas is reflective of what's happening all across the country. We're seeing rent growth levels slow down. And the reasons that we see it happening locally are the same reasons we see it happening all across the country. Number one is operator behavior, operator sentiment. They're just a lot more hesitant to raise rents now that resident turnover, resident churn is picking back up to more normal levels. And so they're really focused on backfilling vacancies and keeping occupancy rates in good shape. The second key reason is that we're seeing a reversion to the mean in the loss of renters to home purchase. Home sale volumes are not back up to pre-recession highs, but they are climbing significantly all across the region. I'll give you some numbers for the 2 big metros in the Carolinas. Year-over-year home sale totals surged 23% in Charlotte, and they are up 19% year-over-year in Raleigh-Durham.
And certainly those turnover numbers do come into play in the attitudes toward hiking rents. But another factor to certainly look at, particularly at the top of the market, we are seeing an increase in construction. And so a lot of this product hasn't come on yet, but as operators see it underway across the street, that does make them, again, a little bit hesitant to push the rent numbers. So we've got a chart for you here that looks at the construction numbers going on across these metros, some details for you, and particularly look at these top three on the list: Raleigh, Durham, Charlotte, and Charleston, all set for inventory growth of 5 to 6% over the next 18 months or so. As you look across the country, the most aggressive number on inventory growth is in Austin, where about 7% increase in the stock is on the way. But these three Carolina ones are the next three on the list after Austin, so very aggressive. More moderate growth of 2.4% in Columbia, and then just a little bit of growth in Greensboro, Winston-Salem, 1.8% inventory growth, and then just 0.4% in the Greenville, Spartanburg area.
So clearly, Greg, supply is going to be a big factor again going forward, and how fast these markets are able to lease up all of this new supply. So that being the case, crystal ball time, what are we expecting in terms of performance over the next year?
We do think that the slowdown that we saw of late is something that we're going to see continue at more moderate performances compared to where we were in 2010, 2012. Looking at the ones that have really aggressive construction, we do think that they can handle that in the big picture, but you're certainly going to see occupancy slide a little bit as all that product moves through lease up. And particularly, we think that Raleigh-Durham might have a little bit of a lag there in terms of getting all that product through the pipeline. But overall, still pretty healthy occupancy rates in this part of the world, but the rent growth numbers just won't be spectacular in these markets. Probably at best doing about what the national average is, and there's certainly some possibility that at times, as you go through this process, these are going to trail a little bit.
And Greg, if there's one market we think could outperform, that could be Greenville, South Carolina, the upstate South Carolina region. Strong job growth, great demographics, especially for a smaller market, but you don't have a lot of apartment construction. So it's one of the few spots that has the economy, has the demographics, but not a lot of development yet. So we could see some pretty good numbers there. We also want to let you know that we'll be talking about the Carolinas and all of the major Southeast markets at our upcoming Southeast Apartment Market Conference in Atlanta at the CNN Center on May 21st. You can get more information about that at mpfresearch.com. So with that, we wrap up the Carolinas. So until next time, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.